Welcome to Advisor Q&A today. I'm Tony Kay, I'm the editor of InvestSMART, and I'm joined as always by my panel, Max Newnham. Welcome, Max. Good to have you. Bruce Bramall.
Thanks, Tony.
Bruce and Max are both licensed financial advisors. Now, today's topic is on the super franking question, and it's a hot topic. We've had so many questions come in on this. There's press coverage on it just about every single day. So what we want to do today is really just go over exactly where we are, what's happening, and also go over your questions. Firstly, I just wanted to start and set a bit of background to it in case you're not fully apprised with what's going on. But in March this year, the ALP announced its policy on franking credits, and basically what the ALP is saying is that from July 1, 2019, its policy would come into play, and it would abolish franking credits, franking tax rebates basically on dividends, which has already caused quite a lot of consternation amongst investors. There's a Senate inquiry actually going on right now in Melbourne today. They've already had hearings in Sydney where submissions have been put in from a whole range of different places. Today the CPA group, IPA, AFIC, the fund manager, and also other groups are putting in their submissions to the inquiry. And in Sydney, we've already had a fairly active campaign from Wilson Asset Management, and even to the extent where there were protesters holding up signs outside the committee a couple of days ago. So it's a really, really hot issue. So I think I'll just start by getting Bruce and Max to talk through how franking credits work now and more about what the proposed policy changes are. So maybe I'll start with you, Max, on that.
Yeah, it was a change that was made, I believe, in the Howard days. That and it's on a fairly solid base that there's that when a company gets taxed, 30%, say. It was felt that it would be inequitable that the shareholders of that company, if the company made $100 profit and then the $70 was distributed to the shareholder, that the shareholder paid the tax on all of that $70. And if they're on the top tax rate, they're paying maybe about almost another 35. So therefore, on that $100 worth of income, 65% has been paid. So to stop that happening, they said, okay, when you get a dividend from a company, you as the shareholder has to show the $70 of income you received plus the $30 franking credit, then you pay tax. If you're paying tax at 47%, well, you have to pay the difference. If you're paying tax at 34.5% with Medicare levy, well, you're paying the difference. But if you're the lowest tax rate or paying no tax, you get all of the tax paid by the company refunded. And so that's where it's coming from a point of view. And basically Labor saying from now on, a franking credit cannot produce a tax refund, which is very similar when you pay tax on international income, overseas income. The tax that you have paid in the overseas country reduces the tax you pay in Australia, but that foreign tax cannot create a refund either. So they're sort of bringing it into line with that.
I just wanted to say, and I probably should have said this at the outset, that Labor came out with its policy initially, and then they did a back down in a way. They said that
within 2 weeks.
Yeah, pretty quickly. They said that they would be protecting those on the age pension from this change. So if
huge shareholding population.
Yeah. If people are receiving the age pension and they do happen to have shares, as you say, Max, probably not a lot of people on the age pension do, But there would be.
If they're on a part pension, that would be the case.
Labor says it's 300,000, so I suppose it's not insignificant if we can believe, all the calculations.
Believe politicians. Sorry.
That's right.
Well, a lot of them would have picked up over the years the Telstras, the CBAs, the NRMAs, IAG nowadays, but they would have picked up small shareholders in that and held on to them. And the franking credits from those dividends that they've been getting would have been topping up their income by an amount. It might only be $50 in some cases, maybe $1,000 or so for some very small shareholders.
So it would obviously help people on the age pension, but people not on the age pension are the ones who are going to be affected, and they're primarily self-managed super fund trustees and others who may hold shares outside of their super fund, directly. So there's a lot of those. I've seen numbers of over 1 million. I don't know the exact number, but it's quite high, and that's obviously where there's a lot of consternation in terms of how is this going to affect people. How can I structure my portfolio, perhaps to get around this change, if that's possible? Otherwise, what changes do I need to make?
Well, I think first let's sort of do the large groupings of who is going to be affected by this, so that people understand who it is. The first one is self-managed super funds in pension phase. So they might have had $1 million in pension phase. They're earning $50,000 in dividends on that $1 million. There's tax credits associated with that, about low 20s, or $22,000, $23,000 roughly. Under the current policy, they get a tax return of $22,000, $23,000. Under the Labor policy, if a whole bunch of things happen, if Labor wins, if they can get it through Parliament, if they can, don't make any further concessions, then they will stop getting that tax refund. So that's one, and that's why it's the biggest group of people that are going to be impacted, and it's why quite a few people are referring to this as a self-managed super fund tax. Outside of super, still inside super, but in superannuation phase, the tax credits will help offset how much tax you have to pay in accumulation, but you still can't get a tax refund from the excess credit. So there will be an impact there. But one of the reasons people are saying this is self-managed super fund tax is because for APRA regulated funds, hundreds of thousands of members, the tax credits will be able to be used across the whole spectrum. So a lot of the credits will still be able to be used, which therefore won't impact as heavily on APRA regulated funds. So it comes down again to this is a self-managed super fund tax. If you listen to what Bill Shorten said when he first announced it, he was talking about one example of one super fund that got $2.5 million worth of franking credits coming back into the pension fund. It's probably talking about a year before the 1.6 million kicked in. 1.6 million transfer balance cap kicked in, and there was one fund that got $2.5 million in credits back. Taking one example is
which interesting. His policy is not going to affect that now, because those people that have got the huge accumulation account now will still be able to use it.
Have something back. For a lot of people who do still have a big accumulation balance outside of their pension fund, not everybody, but for a lot of people, this will be essentially neutral. The franking credits will help offset the tax they should have been paying, or they should be paying on contributions. So there's a big number of people there who it'll be marginal effects, a little bit up, a little bit down. The next big set of investors that this is likely to impact on are those who have a marginal tax rate of less than the 30% franking credit rate. So that means pretty much most people earning $37,000 a year are paying marginal tax rate of 34.5%, including the Medicare levy. Aren't going to get the credits back. In fact, they're still going to be paying more taxes than they are currently. So it's the people earning less than that are going to be will feel the impact. But then anybody receiving Centrelink benefits. So and self-managed super funds, where one of the members has receives a Centrelink benefit. So I wrote a piece about this early on, and it was silly and out there, but it's what could be done. And you might have a couple with a smaller balance in their self-managed super fund, and somebody over here who has a $30 million fund, a partner swap. Switch members across from one to the other.
Going back to the 70s and 80s.
Go back to the 70s and 80s, and you're not suggesting throwing keys in the bowl or anything. I'm sure they're Max, but
no.
You could do that, and if one of the members in this fund now had Centrelink benefit, and one of the members in this fund still had a Centrelink benefit, then it meant that both funds, even though one was worth millions and millions of dollars, neither of them were going to be impacted by this tax. So there'll be more loopholes that are going to be found, but they're the 2/3 biggest groups that will be impacted.
I saw some research, and it was done. I forget who it was done by, and there are going to be some super funds, even APRA regulated, and some industry funds, those that haven't chosen to amalgamate with like one of the bigger super funds, where you have an ageing population of super fund members, and I saw some research done. There is a tipping point at where it ends up being where you've got less than 40% in a pension phase or something. There's going to be other funds that are going to be unintended targets of this. So I think it's very much watch this space. We've got the Senate committee. It'll be really interesting. And I think one of the things, though, interesting enough, in the end, if it does come through, it actually changes my advice in relation to bringing children into a super fund, because you could almost have, therefore, a self-managed super fund where the fact that the franking credits won't be lost by bringing your children in, and with their contributions coming in, it could actually mean, and I think I wrote it in one of the pieces I did, is that you could almost now have that self-managed super funds become an intergenerational type of fund, because it makes more sense for people to have their kids in there that are making super contributions, which, the franking credits means that the super fund doesn't pay the tax office any money, but the parents who are on pension effectively get the benefit of that franking credit.
Okay, so if we have a 19, 20-year-old on unemployment benefits, with mum and dad in their 50s with a very large fund, but the 19-year-old is a member of the fund receiving unemployment benefits, it's a Centrelink benefit. Does that mean that the whole super fund, or is it an age, specifically an age pension?
Where it comes into it is, when you've got the whole fund in pension phase, if they bring in this piece of legislation, clearly, let's talk about an imputation credit of $15,000. Right? If there's an imputation credit sitting there of $15,000 that the fund used to get, if this comes in and they do nothing, they effectively lose $15,000. If they end up having 3 children that are earning decent money, that are making contributions of $15,000 each a year, at $45,000, you've got the 15% tax on that, plus the tax that would have been paid on their accumulation accounts. It basically ends up, which is what happens in these APRA funds. You've got this huge mass of accumulation fund members that end up with $1 million in tax to pay, and you've got the pension fund members that are due for $250,000 in tax refunds. Well, that super fund only ends up paying the difference between the $1 million and the $250,000, and those pension fund members get credited with, yes, this is really your money we've used to reduce the liability in the super fund. So it's in that situation. That's why it's certainly not going to be any good if you've got someone on unemployment benefits, but if you've got 2 or 3 kids, and it can be up to 4 kids if that legislation passes, increasing the membership from 4 to 6, it could become a very viable option to end up bringing the kids in, whereas before it can become an administrative nightmare and an added cost. It could become, very worthwhile.
Just wanted to make one point, which is an important point really, is that even though many believe that Labor's got a high chance of getting elected at the next election, it's not a time to take any rash action right now, because firstly there could be some more changes on this policy anyway, and secondly, in terms of perhaps sort of getting out of assets which are attracting franking credits now, I wouldn't do that. I'd really just wait and see what happens in the space, because
there's a little
bit too early.
There's a lot of water to go under the bridge. You have a look at the online betting sites. They're saying Labor 125, Coalition 350, but we're still roughly 6 months out from an election, and a very damaging internal brawl and ousting of a leader. In recent months, things will change. They won't probably go into that. But Labor needs to win. Labor needs to, if there's a hung parliament, they're in trouble getting this thing through. Even if there isn't, there's still a lot of argy-bargy to get through and trying to convince the parliament to pass the legislation. But also, as several people have pointed out, 660,000 self-managed 600,000 self-managed super funds, 1.1 million self-managed super fund members. That's a large portion of the population to, let's say, annoy, peeve, leading into an election. So, it's one policy, and you don't ever make a decision based on one policy. But there certainly will be people who will make the decision solely on this policy. So there's a lot to go through. There's a lot of other things that Bill Shorten's ALP wants to do as well in regards to negative gearing and
capital gains tax, distributions to trusts.
There's a lot of things there, and people might make decisions on all of those. Yeah. This is one of these, and what you said, Tony, is 100% correct. There's no point panicking about it now. It's something that you might start to think about. You just start thinking about, okay, what is my portfolio? What am I? How much am I receiving by way of franking credits here? Is it too much? Do I need to start thinking about doing that? If I perceive this to be a real risk, do I need to start doing it? But the world's not going to fall apart when this happens. If you've gone into a stock that's paying a 5.6% fully franked dividends, 5.4 goes up to 8%. Anyway, 8% franking. There's an element there that is the franking credit, and if you've only chosen fully franked stocks to be invested in, then yes, it's going to have a bigger impact on your portfolio. But you should be further and better divested than that anyway. So if this is your tipping point to say I'm too reliant on fully franked stocks, which if 100% of your money is in fully franked stocks, then you're likely, if all of these things happen and the law comes in, then yes, you're probably going to take a 30% hit to your to the net income stream that you receive from your super fund, and that is a pretty big risk. It might be time to start thinking about, well, as opportunities arise, I need to take some profits here. I think this one's reached the top. What's something else that I can invest in to start potentially diversifying? But anybody's got 100% of their money sitting in fully franked companies, or companies that pay fully franked dividends, is probably chasing the wrong thing anyway. Returns are about two things: growth and income, and having a healthy balance around both of those is important. So I think it's something people to start thinking about now, but this may come in on the 1st of July 2019. They might not be able to get it through in time. It might not come in for a year after that, until 2020. You don't know.
Yeah, it's a good point, Bruce, and I think, if anything, this should be a perfect opportunity for people to be thinking about talking to a financial advisor about the structure of their portfolio and where it can be improved and diversified, made more balanced, because, as Bruce says, you don't want to be fully exposed to income equities or fully exposed to equities for that matter. You want to be balanced across different asset classes, and perhaps some of our listeners today might want to consider getting an independent perspective on their portfolio and how it can be better improved. Better improved, not this phrase, but
much more better improved. Yeah.
Better improved.
Yeah.
Okay, so I think what I wanted to do now, have we covered off all the main points? Yeah. what I wanted to do now, we've had a lot of questions come in today, and we'll try and get to as many of them as we can. Those that we can't get to, we'll certainly answer in our commentary, either in Max's column or Bruce's column or separately. So
there's probably actually one thing, Tony, it's just occurred to me that I have read a little bit about, and people doing some exercises on, and that is some people saying, well, I'm going to take out all my money out of my self-managed super fund and put it into either an APRA-regulated fund, which I'll ignore for a second, but put it into my own name, because once you work out the tax credits and whatever, and not having to pay for the running of the fund any longer, that I may well be better off. And if you do some of these exercises, you can show that, yep, okay, you might end up better off in some circumstances by a portion of doing that. But what most of the all of the examples that I've seen so far ignore is that once you pull that money, pull those funds, those stocks out of super and into your personal name, if you ever do go to sell them, you have capital gains tax to pay on the gains, and that will have a sizable impact on the returns from those. There's nothing said yet by Bill Shorten or the ALP to start taxing pension funds or to tax gains within superannuation at any more than zero for pensions or 10 or 15% for accumulation funds. So a lot of the examples that have shown, this will show that I'll be better off having the money outside of super, doesn't necessarily stack up beyond just a straight tax perspective, particularly because of capital gains tax.
Okay. I'll just read out these questions. We'll go through them one by one. But a common one that seems to be coming through is where people have got a self-managed super fund and they've got some assets in accumulation and some in pension phase, and whether there's some sort of a workaround on this potentially. So Eamon asks, can we outline the understanding of how the changes will relate to this sort of scenario, and whether the franking credits can be sort of utilised within the accumulation phase?
That's not changing. That's still the case. The only thing they're changing is that where you have a super fund totally in pension phase, it cannot create a refund from imputation credits. They are not looking at changing imputation credits or franking credits to be able to be used to decrease tax payable by other members in the fund. In other words, that's going back to what I was talking about before. It's where if you've got a self-managed super fund and everyone's in pension phase, it could make sense getting people in to have accumulation accounts that are making taxable super contributions. That's the way you can rescue that. There's no talk about, no, you can never use those imputation credits, the franking credits, to offset tax. That's not in the wind.
This week.
This week. On that also though, Tony, when you're talking about being in accumulation phase, if you get the $100 refund, $100 dividend of which you paid $70, and so there's a $30 credit associated with that. As it stands at the moment, in accumulation phase, of that $30, you would get $15 back, essentially. The tax position of a superannuation fund and accumulation fund is 15%, so you would get that $15 back. If you've got somebody, and you won't get that anymore, however, you will be able to use part of those with things like contributions that are being made that will help to soak that up. So there will be a lot of accumulation funds where this has a net neutral impact on it. I think that's partly what this reader was asking.
I think if there's contributions going in, and in most cases, they're in accumulation phase because they haven't been able to start a pension and they're making contributions, is because when you look at it, the combined effect of the 15% tax on contributions, 15% tax on any income that the accumulated value of the super fund's earning, it's very, very rare that you'd find an accumulation fund would be getting a refund of franking credits. Very rare. I've never found it in a self-managed super fund. So that's where it'd have to be a unique situation where, that situation where the accumulation account would be likely to be getting a $15 refund, because it's I mean, there is a situation if all of the fund members stopped contributing, and therefore the 15% tax doesn't come up to that. But you know, it's not that often I've seen that anyway. I don't know about whether you've seen it. So, yeah.
Okay, the next question is around trusts, testamentary trusts. Max and I, you've had a chat about this offline, but Bruce asks, how will this policy apply to testamentary trusts and beneficiaries?
I think I remember the question that Bruce came in to say, well, look, you know, with this particular change to the franking credits, he had believed that there were some exceptions going to be applying to this. The only exceptions end up being charitable. The only exceptions end up, I think, being a charitable trust situation where that can end up creating a refund as far as the imputation credits, and we've got the exceptions relating to people on pension. But I think what Bruce is referring to is that the other Labor Party policy is that all distributions from trusts, apart from fixed trusts, and fixed trusts are unitised type of trusts. And so what they're really doing is targeting family discretionary trusts. Any distribution to an individual from a family trust will have tax paid on it at least of 30%. The only exceptions to that are deceased estate testamentary trusts, and there's one other. So in Bruce's situation, the 30% tax would not apply to income distributed from the testamentary trust, but what could not happen is if there are franking credits being distributed from the testamentary trust to the individual, that individual could not, if they're not paying tax apart from the trust distribution, they would not be able to get a refund of those franking credits. So there's two policies caught up in that question, and testamentary trusts could be affected by not being able to have the ability to franking credits create a refund, but testamentary trusts are not affected by this blanket of 30% tax.
Okay, next question's from Peter. Peter and his wife are both aged over 70, but they're on the fringe of the age pension, so they're sort of in this little bit of a limbo land.
Twilight zone, it's called.
Yeah, twilight zone is good. So the question around that is really, I think, you know, should they sort of edge towards the age pension to get around this?
I don't know how they'd do that.
Well, I've read there's going to be some pretty creative ways of making sure that you can pick up just a few bucks of pension, age pension, which, you know, there's rules and Centrelink, you know, assets tests and etc. But, you know, I think people will become just that little bit more desperate to have their assets come in under the assets test threshold, so that they pick up a few dollars, a couple $100 worth of pension, of age pension, so that, because once they do that, or once one of them does that, bang, the super fund gets the exemption on it as well. So I think that's sort of likely, because, you know, if you can do something fairly small to do it and get away with it, then why wouldn't you?
If it applies to someone who, I think, is at 830, I think is the assets test, it's gone up from the 813 when they reduced it originally to up at about 830, 840. If someone is within, I mean, if you're within 10,000, you're able to give away 10,000 per year, and it therefore come off your assets. And the maximum you can give away over a 5-year period is 30,000. For people that are in those areas, some of the creative things could be that, yes, it might be worthwhile giving away, you know, over 2 years, 20,000. The other thing is to look for those things that are Centrelink asset exempt, like funeral bonds and things like this. There are some people that, you know, think, oh, well, I'll worry about my funeral when I'm dead, which is sort of doesn't work. But the thing is if you end up prepaying a funeral, that cost of the funeral comes off your assets. So, you know, maybe time to do house renovations. It may be time to I mean, you could buy a 250,000 Lamborghini that ends up dropping down to 150 as soon as you drive out of the showroom. That could work, but you have to end up being fairly close to make it reasonable to do it.
Yeah, but it may well be the case. It's something like a renovation. You know, you're 65. You're intending to spend the next 20 years in your home, 30 years in your home. Okay, well, we haven't done the kitchen for 20 years. Let's do that properly. 50 grand, 80 grand, whatever it happens to be, bathroom. And all of a sudden, the value of your home goes up, but your assets go down. Your home is encountered, blah blah, and it can get you under the assets test and potentially get you qualified for the age pension and the roll-on effect of not being, getting your excess franking credits back in there. So there will be not a huge number of a proportion of the population that will be able to potentially do that if it's going to be worthwhile for them.
Bucket list trip might end up coming more of the fore, and it might be said, gee, if I go business class instead of economy, I'll end up with the pension. So
It's very much a case-by-case situation. I mean...
it will be, absolutely.
Yeah, it just may not make sense. I mean, if the numbers don't really stack up, and this is where you need to see an advisor.
Definitely get professional advice because it's
don't
a
just go and do it. Yeah. The second part of Peter's question relates to a specific situation. I won't mention company names, but one of the companies he's invested in has a holding in an asset which the company has said that we want to sell that asset and return the proceeds to shareholders, special distribution with franking credits, similar to what BHP's just announced separately with the shale oil. So they're going to be returning funds to shareholders. So I suppose Peter's asking, the ATO's already given a ruling on this apparently, and I suppose there will be a lot of scenarios between now and the election, perhaps, where companies do choose to return proceeds to shareholders because they've got large franking balances.
If it works out that there's a high likelihood that Labor will get in and they'll get a chance to put this legislation through, that it would be, if companies have been thinking about it and they do want to reward their shareholders rather than leaving things behind, that puts a time limit on when they can be doing it, because I don't know about the ruling and stuff you're talking about with the ATO, but if they're paying a fully franked dividend, well, it's a fully franked dividend and the taxpayers get the credit for it. If the law gets passed and then that situation happens in the future, it may not make that as attractive a way of rewarding shareholders, in that form. It may be we'll do a capital distribution where at least the money that comes out could end up having a 50%, or as Labor's saying, a 25% discount on it. So it's again be very interesting to see what happens.
Rob has a question. It's more of a timing issue, but from the date that this policy would come into effect, if it does come into effect, if a company announced that it was going to make a special distribution before that date, but the actual payment was after that date in the next financial year, whether that's allowable, that's basically Rob's question.
The devil will be in the detail. If, as they're saying, we will be banning franking credits creating refunds from July 1, 2019, guess what that means? That means for the 2019 year tax returns that are lodged after the 30th of June, any people, and this is where it could be almost regarded as a retrospective tax, because it would mean anyone that's now current, would not be able to get a refund for their 19 year. This is where it'll come down to the detail. If they say for every tax return lodged after the 2019 year, refunds won't be allowed. So, it's very hard. Again, until it's in black and white, we're not going to know.
No, and if a company is making these sorts of decisions based on wanting to hand back franking credits to shareholders, and get them off their books, then they're just going to need to either make sure they do it by June 30, make the payment by June 30 next year. If they do it on July 5, then they're taking the risk if Labor gets the policy in on time. Actually, one thing that might be interesting, Max, is that 3 of the 4 major banks pay their fully franked dividends in the first couple of days of July every year. I think it's It's all but CBA. Westpac, ANZ and NAB tend to pay it on like the 2nd of July and the 4th of July to throw it into the next financial year. They've done that for...
Is that when they've declared the dividend?
No, when it's paid.
But see, the interesting thing is you have to pay tax on dividends upon declaration, because that's what the tax office gets. If you look at it, there's always the two things. I mean, it'll be interesting to see, you're right, whether they will change that, if that's the case, because one of the things I know within a super fund, you end up having the income may be received after the 30th of June, but because the declaration of the income, whether it be a dividend or something's made, and it's due and payable, on say the 28th of June or 15th of June, it's normally done on the time that you have an entitlement to it. So I don't know. It'll be very interesting.
I thought you paid it in the year that it was received, but
I mean, this is where it gets so hazy sometimes, and I wish that we didn't have to do this proper accrual accounting for self-managed super funds, which creates a massive... It'd be a lot better just to do it on the basis of the income received, but you've always got these, tax effect accounting and all of these other things that go on with a self-managed super fund. So yeah, it'd be interesting.
Now, I've got a fairly lengthy email from Don, and he's gone to the trouble of doing some calculations. Now, you guys are the experts on this, so I'm going to hand it over. But I think the point really that Don wants to make in this is that it's a very, very complex area. Yeah. And once you start doing the tax calculations, depending on who's paying what level of tax in the family and within the fund, etc., it's really where you need to go and see the experts.
Well, while Max is reading that, when Bill Shorten announced this, he said that when the policy came into force in the early 2000s, I think it was 2002, the government was going to be, the cost to government was going to be $500 million. At the time now that he was announcing it, it was costing $8 billion a year. That's his numbers. I'm not going to say whether they're right or wrong. But therefore, basing this on saving the majority of that $8 billion being able to come back into the budget, according to Shorten, to pay for schools and hospitals, etc. But whenever you make rules, people find ways around them, or how to push them out to the edge. We talked about a few today of people sort of renovating the house to get back under the assets test for the pension so that they can squeeze into the self-managed super fund and get the franking credits there. Anytime you make rules, people will find ways around them. There's leakage. He will not get the $8 billion. It'll be something less than that. People will find ways around it, like putting in the kids into the super fund instead of their first job at in retail or whatever, paying a part-time job, going into the industry funds that the employer recommends. It might be a case of, well, actually no, come into the family super fund. It's not going to cost you anything, and there's going to be some tax benefits for the family. So do that. So there may be sort of advantages that way, but getting around it is complex. But anytime you make a law like that, people will find the grey areas and take advantage of that. It always happens.
To basically sum up Don's complicated calculations, it reaffirms the fact that if you're on 19% tax rate, you get a refund. If you're on a 32.5% rate, you have to pay a bit of tax. If you're on the 45%, you have to pay tax. And if you're in a superannuation fund in retirement mode, you get a refund. Where I disagree with Don, and although he says he is no fan of Bill Shorten, he thinks that it is incredibly inappropriate that self-managed super funds could be getting these refunds. That's the law. And what amazes me is that you have the Labor Party that's coming from their traditional roots, which is supposed to be classlessness, although some people are more even than others and under that system, that you're creating two classes of people, the haves and the haves not. And to me, I disagree with that totally. Fairness and equity's got to come into this. Whatever the law is, it should apply equally to everyone. And it's a bit like with the situation with the Labor Party's policy to tax distributions from family trust at no less than 30%. They are therefore treating Australians like they are non-residents, because if you're a non-resident of Australia, you pay at least 30% or whatever it is on all of your income. So, I can't understand why someone would want to promote something which creates classes again. it's just no. I don't. Well calculated summary of the way that franking credits work, but do not agree with the fact that we should be picking out self-managed super funds as being a pariah of the tax society and let's punish them, which is basically what Don's saying. I don't agree.
Yeah, and you only really have to look at the numbers that come out of the ATO and out of the SMSF Association, showing average balances in self-managed super funds. I mean, not everyone who's got a super fund has got millions of dollars in their super fund. Some of them might have $200,000 in there. Whether they should have one or not is one that Bruce addressed this week. But certainly there's a very broad spread of assets across self-managed super funds. Brett equally has written a bit of an opus for me. It's not so much questions, it's just sort of making some points which he wanted us to raise. I think we've raised most of them, but a couple of interesting ones is alluding back to what we were talking about before about people perhaps getting onto the age pension, by doing renovations or whatever it may be. Not that we'd advise that, but he's saying that if that happens, obviously that's just going to be putting more pressure back on the welfare system.
And it's interesting, whenever I do a plan, I'm always looking ahead quite a few number of years. And you can have people that have a reasonable amount of capital behind them at the present, which could be in a self-managed super fund, and they're over the assets limit. And they don't want their standard of living to drop, and they get to a point where the money that they're taking out of their super fund is more than the income that's being produced. Quite often, inevitably, unless you're talking about the people with 3.2 million or things like this, inevitably they get to a point where they become eligible for a small amount of age pension. And interestingly enough, I don't know whether they've factored this into their policies, is that there will be some people that self-managed super funds don't get that now, but eventually they will.
Yeah.
So,
can I point out an example that I think Max has alluded to? Let's take a company that's made $100 million worth of profit. So it's a very solid company. It's made $100 million worth of profit. The shareholders are totally self-managed super funds. It's not going to happen again, but let's just say for the purpose of this example, and the whole $100 million after tax paid of 30% is paid out. There's $70 million paid out to all of these super funds with associated $30 million worth of tax credits, or including some people on zero tax, but people earning under the tax threshold. In that example, and this is one that the people supporting Labor's idea suggest, is that what happens out of that situation is if everybody's in pension phase and gets the self-managed super funds are all in pension phase, they actually get that $30 million back. So this company has earned $100 million, but the government hasn't received a single cent in tax from it. Now, this doesn't happen because foreign investors own about 40%, give or take 30 or 40% of the Australian market. So this sort of thing would never happen. But that's one of the complaints about it, is that you can have a company make an enormous profit, pay the tax, handle the dividends fully franked to investors who don't pay any tax, who then get that $30 million back. So a company's made a huge profit, no taxes. Once you even things out, no tax has been paid. So that's what Bill Shorten is complaining about in this situation. One of the things that he's targeting in this situation is that some tax should have been paid on that $100 million profit, or a higher proportion, given that sort of situation that I just outlined doesn't exist. But a good portion of that $30 million does get clawed back by self-managed super funds who are chasing fully franked dividends. So anyway, that's just one of the things To
summarise what you just said, Bill Shorten is using sightings of Yetis and Bigfoot to support his basis. They're fairy tales. As you said, there is no such company.
There's no such thing, and Shorten isn't suggesting that there is such a thing. But where pension self-managed super funds are chasing fully franked dividends and getting all of the tax that was paid back, the company that initially made that and passed on the franking credits and dividends the government essentially isn't getting a portion of that tax, isn't receiving a portion of that tax. They do, and then they've got to give it back. So it's weird.
You know, the way be if they didn't get through with the franking credits, they might end up saying, okay, from now on, self-managed super funds can have no more than 50% of their capital invested in fully franked shares. I mean, that would achieve and alleviate the problem. It's interesting depending on the way they go. That would be another way of solving it. Yeah, who knows what the bureaucrats will come up with as another way of fixing the problem.
Yeah. Any super fund that has more than 50% of its investments in companies that pay fully franked dividends is probably needs to have a think about it. In any case, for diversification purposes.
I can't believe how the GFC didn't teach people something.
Yeah.
Next question is really from John, and it's around what I spoke about earlier about not doing anything rash. But John saying, how do I future-proof my portfolio if this comes into effect? In terms of, should John be going more international, more into assets that are not reliant on franking credits?
I think it should be a wake-up call for a lot of trustees and how they've invested in the funds. If they're over-reliant on franking credits for returns in the fund, it looks like what happened, they might be able to sail in the future happily and receive them. But absolutely, they should be starting to. If you do more than 50, 60, 70% of your funds invested in Australian shares, and majority proportion of that in fully franked shares, companies that pay fully franked dividends, then yeah, you probably should. You should have be possibly starting to look at taking in some international assets, potentially be further invested or diversified through bonds, property. It might not be direct property, but it might be or the like, which do have tax advantages on the other side that aren't the fully franked credits up front. So yeah, absolutely. If too much of your return is based on getting those franking credits back, then you probably need to start looking at it and doing it now and looking at a bit of diversification. Franking credits are a part of the income portion of returns. If you're in Australian shares, the other portion of that should be about growth. And Australia and super funds in particular have developed this reliance or this want to be in the fully franked dividends. But fully franked dividends tend to be lower growth companies. And that's something that, they probably need to have a look at.
Negative growth like the banks.
Or negative growth like the banks. They might, banks might be paying fantastic dividends and AMP and Telstra, but look at their share price going backwards.
It's amazing how much you can
dividends
apply that principle a lot of different asset classes, because even in the real estate area, you can go and get something that's paying a really high income yield, like there's student accommodation, there's defence services accommodation and stuff. They pay great income, but you miss out on the capital gain because they're just not coming up. And it tends to often be that sort of connection. The higher the income, the chances are you don't have the same sort of growth.
Correct, yeah. And for a lot of people, income is far more important than growth, but for a lot of others, the growth should be more important than income.
I've got a question from Rob, which is an interesting one, and I've got a slight variation on it as well. But Rob is saying, is a way around it for companies to issue bonus shares to shareholders instead of dividends? And then my add-on to that was, do dividend reinvestment plans?
No, because in the end, bonus shares, it would mean if they're issuing bonus shares, they're getting this massive amount of accumulated profits with a huge franking account balance that doesn't seem to get used. And if you issue, if in dividend reinvestment, the taxation of it is you still have to pay tax on the
capital gain.
On the franked dividend. See, I mean, you get shares instead of cash. So you still pay tax on the dividend you received, but instead of having cash, you end up getting shares. And with most of the self-managed super funds and people I advise say, why would you go in for a dividend reinvestment plan? And so many companies have dropped it because you are choosing to buy the shares every year that there is a dividend made when, InvestSMART or someone was saying, no, this is a hold or it's a sell. To me, making that conscious effort to go back in. I know it's worked for a lot of people over a long period of time, but no, it doesn't alter the fact that dividend reinvestment.
No, they certainly don't always work because you're basically exposing yourself to the market.
That's it.
In a bigger way. Question from Mark. Now, it's also a long one, but basically what Mark is asking about is bringing your kids into your super, which we've spoken about in a fair bit of detail. But he's asking, is that a sort of a viable thing, and to do gifting, etc.
Gifting won't. I don't know why gifting would. The only thing, as I said, you can if you're wanting to be able to gift to get to the below the asset level, you can only gift $30,000 a year, except
30,000 over 5 years.
So 30,000 over 5 years. The interesting thing is, if you were 200,000 away from it, and you were thinking of giving the kids some money before you fell off the twig anyway, a gift only is affected over a 5-year period. So if you gave away $200,000 now, at age 60, or even if you're 65, if you gave away 200,000 now, by the time you've reached 70, that 200,000 gift is not counted. So again, it's not a one size fits all. You need advice on the way of structuring these things.
I'm just having another read of Mark's question because it's a little bit complex, but he's also suggesting that the gift gets rolled into the kids' super as well as a contribution.
If it's a non-concessional contribution, sure, but then the gift has ended up still going to be classed as an asset for up to 5 years, so it won't have an immediate effect.
But I have looked into some of those strategies, and what people are considering doing is giving the gift to the child so that they put the money into super and get the personal deductible component of that, and that can be an effective way of potentially gifting money to your kids.
And it could be another good way, because with the first home buyers situation, giving them the money to be able to make the deductible contribution can end up creating a situation where they're going. It's only $30,000, but if it was a couple, there's $60,000 that they would have had.
That's right. It was you and I were talking about it when we did the first home owners grant thing, first home super savers scheme a few months ago.
Last question I have is from Jeff. Jeff's retired at 64 years of age. He's got his super still sitting in his former employer's fund, and he's got balances in accumulation and pension mode. So he's asking, will he lose the benefits of the refunds on those credits already paid into the fund?
If it's an APRA fund, the only way he would lose it is if that fund had a high percentage of people in pension phase with a lower percentage in accumulation. The only people that will be affected are those type of funds, which there aren't many of them, but it could become increasingly number as a population of a industry super fund age, and they're becoming retired. There is a risk in that, and the other one is self-managed super fund.
All right, well that takes us through all the questions today, but let's just sort of summarise by wrapping up here, and the point I wanted to make again is that this is still a work in progress, and all the listeners really should be seeking out professional advice on their portfolio beforehand. Don't do any rash changes, but certainly consider the potential impact of this change coming in and what it would mean for you. Any other comments, gentlemen?
I'd back that up. You never should be doing anything or taking action on the basis of policy. Because, as you said, it's up to the Labor to win the next election to have a working majority in the lower house. But as we're seeing, and it's not just Australia's population, the worldwide population is becoming very disenchanted with the status quo and the old political systems. And that's why we're getting more and more of the independents. So we could find that, Labor gets in, but because of the number of independents that end up holding the balance of the Senate, and it's a shame poor old Don Chipp's not around in his original form, that can be a great regulator. So, but do not do anything apart from maybe take this as a wake-up call, like we've been talking about. If you are if you've got more than, I would have said 70% in the Australian share market, you really need to have a look at what your potential risk is for loss, for if there's an economic downturn with dividends reducing, the chances of not having as much income and being forced to sell assets. To take this as the opportunity to look at your portfolio and see if there is a better way to construct it, just like we have on the InvestSMART site.
Yeah, thanks for that segue, Max, because I was going to say listeners should actually go to the InvestSMART Portfolio Manager, put in your details, and then you can actually do a health check on your portfolio, and it'll tell you basically if you're way overweight in certain areas and potential ways that you can balance out your portfolio. So it's a good tool. Bruce, any last comments?
Well, look, same thing again. It's not time to panic. I think Labor's got to win. It's got to have majorities. It's got to be able to work its way through Parliament. But I do think that people should be taking the opportunity that the next 6 months, whatever presents, to further consider. I bang on about it every year, particularly in July, about diversification, the benefits of diversification, being too overweight in Australian shares, and then even further concentrated into the portion that pays fully franked dividends, will leave you open to legislative risk if this actually happens. Looking at total return, not just your income, not just the franking credits, and start to branch out a little bit now. You might move 5 or 10% of your portfolio now, or start to think about moving that 5 to 10% sometime in the new year. To potentially straight into international shares or Australian and international property, but start thinking about the diversification away from being so heavily reliant on fully franked dividends.
Far be it from me to be controversial. I'm never controversial. If you're going to be getting advice from investment advisors, look very questioningly at their advice if they are saying you should have your investments on an investment platform, because inevitably it adds a series of costs. You're in a self-managed super fund. You've gone in it to be able to have the direct investments. Some of those wrap platforms are great administration savers for the advisors that spruik them, but in the end, be very careful that what you need to be doing is keeping the control of your self-managed super fund, and the premise that you're in it for is to have direct investments and reducing the layer of costs.
Absolutely, and that's another big area that InvestSMART's been pushing. It's all really about getting your fees down, and obviously your returns high. It's no good paying high fees to get high returns, which often you don't get anyway. So good advice. Well, thanks for joining us on Advisor Q&A today. If you do have any other questions around the franking credits area, I'd suggest that you perhaps send them in to me. My email address is t.kaye@investsmart.com.au, and then I'll farm them off to Bruce and Max to have a look at, because I'm sure that you may have other questions. But thanks for joining us, and we'll see you again next time.